70% of women don't invest, which means most of us are keeping our money in savings account where it's losing value every single year to inflation. Meanwhile, men are building generational wealth in the stock market, and the kicker is when women do invest, we actually outperform men. So why the hell aren't we doing it? Because saving doesn't build wealth, investing does. And I'm going to show you exactly how to get started today. But let's start with why it matters. When you save, your money sits in a bank account earning maybe 1% interest, right? And inflation is eating away at it with 3 to 4% every year. So you're losing money by just leaving it there. Well, when you invest, your money is growing an average of 8 to 10% per year over the long term. So not only are you beating inflation, you're actually growing your money more. You're building wealth. And that wealth is the difference between having the freedom to quit a job that you hate, take time off, or make big life changes without feeling trapped because of not having the financial cushion to do it. And you don't need to be some high-powered, rich businesswoman to do any of this. You don't need a finance degree. You just need to understand the stock market. And it's pretty easy to understand it regardless of what anyone else has been telling you. You can start investing right now on whatever your current salary is. If you can miss $50 a month, then you can start there. If you can invest with $500 a month, then do that. Because research shows that when women invest, we make better long-term decisions. We don't panic sell. We stick to our strategy. And all of that is what makes us better investors than men. So the problem isn't that we can't do it, that it's not inherently something that's made for us. It is just that most of us don't do it. And we're going to change that together. So the first step that you're going to take is you're going to open a broker. A broker is basically like a bank account, but instead of just holding your money, it allows you to buy investments. Now here's the part that's going to piss you off. Banks have been making this seem way more complicated than it actually is. Because oftentimes traditional banks also have the option to invest through them. However, they take a cut of your profit for basically doing nothing that you cannot do yourself. In fact, a lot of research shows that when we do it ourselves, we get better results than the banks do. So skip the banks entirely. You want to go for a do-it-yourself broker, and here's what to look for. Low fees is the most important thing. You want to pay as little as possible per trade. Ideally max like $1 or $2 or $3 per trade, or even commission free. It also needs to be easy to use. You don't need something that is super complicated when you're just starting. We want like an app where we can just log in and see how things are going. And we want no account fees because some brokers charge you for just having an account, but that's completely unnecessary, so skip those. To give you some examples, I use Degito, which is a European broker. Trading 212 and Trade Republic are also really good options if you're in Europe. If you're in the US, Fidelity and Vanguard are solid choices. And if you live anywhere else in the world, just Google best broker for your country and then look for the same thing. So do some research yourself. Look into their fees, whether they're easy to use, and whether there's any monthly charges. Pick one, sign up. This only needs to take you about 10 minutes and you're ready to start investing. Then we get to step 2, what you're actually buying. So now that you have a broker, you might wonder, okay, but what do I actually buy inside that broker? And the answer is ETFs and index funds. So ETF stands for exchange traded fund. That sounds complicated. It's not. ETFs and index funds are pretty similar. So whichever one your broker has on offer is fine. And what they are is that they're basically baskets of hundreds or even thousands of companies that are grouped together. So instead of you having to go out and try to pick the best individual stock, which is pretty risky, and honestly, most people, even professionals who do this for a living, they get it wrong. Instead of doing that, you get to just buy an entire pool through one ETF and you own a tiny piece of many companies. So an example of a ETF would be a ETF called VWRL. It contains over 4,000 companies from all around the globe. So you would have Apple, Microsoft, Amazon, but also European companies, Asian companies, companies from emerging markets. And when you buy VWRL, you own a tiny piece of all of those. And if the global economy grows, your investment grows. So you're not betting on one company, you're betting on the entire world economy continuing to grow over time, and historically it always has. Now this is why this is such a good option for beginners. ETFs and index funds allow you to not have to find the needle in the haystack. You just buy the entire haystack. You don't need to research individual companies. You don't need to be reading any financial reports because your money is already spread out across thousands of companies. Another great thing about ETFs and index funds is that you don't need a ton of money to get started. An ETF can cost less than $100 per share. I even own a ETF that is only $8 per share, and some brokers also let you buy fractional shares. So if you don't have the amount for one share, you can buy half a share. So you can literally get started with $10. But none of this beats the biggest advantage of passive investing through index funds and ETFs, which is you don't need to watch the market every day. You buy it, you hold it, you let it grow, and that is the entire strategy. In fact, all of this is so simple that the finance industry doesn't want you to know about it, because if you did, then you wouldn't need them. You wouldn't wouldn't need to be paying a financial advisor to do all of this on your behalf, what an index fund can do better. So all of those excuses that you've been telling yourself about why you cannot invest, they're gone. Okay, now let's talk about what the numbers actually look like, because you might be thinking, is this actually worth it? And I want to show you the math that made me wish that I'd started 5 years earlier. So if you invest $200 a month starting at age 30 and your investments grow at 10% per year on average, by the time that you're gonna retire at 65, you will have over $650,000, and you only contributed $84,000 of that money yourself. The rest is growth. Now, if you would have started at 25 with that same amount of money, you would have over 1 million, and you only put in 96,000. Now, these are just examples. You don't have to invest for 35 years, but the longer that you invest, the more your money compounds, which means that you're earning returns on your returns, and that is what makes the number get so big. However, you can also invest for shorter term goals, and I think you should, because saving for a down payment in 5 years will be a lot easier when the stock market is carrying a little bit of that for you. The point is that investing gives you options. Now, if you're wondering which specific ETF to buy and why, I have a video that breaks down my top picks step by step. I will link it right here so that you can watch that next. But first, let me show you the one thing that separates people who actually build wealth from people who give up after 2 months. Step 3 is the secret: automation. I would highly recommend setting up an automatic transfer from your bank to your broker every month. So whether that's $50, $500, or $5,000, whatever works for your budget, just make sure to automate it. Some brokers even will invest that money for you automatically. Others just allow you to put a automatic transfer between your bank account and the broker so that your money is automatically taken out of your bank account. However, you would have to log in still and invest it manually, but that only takes 30 seconds. Whichever option it has, go for it, because automation is the key here. Now, you're not relying on motivation. You're not waiting until you feel ready. It just happens and you don't even have to look at it, and that is how you actually build wealth. It's really truly not about having a huge lump sum of money and then investing that, but it is about making small consistent contributions over years and letting the market do its thing. This is the part that most people skip, and it's why most people never actually stick to it, even though they know that they should. So don't be that person. Set it up once, forget about it, and let it grow. So here's what I need you to do today. Pick a broker, look for low fees, sign up for it, and then transfer whatever you can into that account so that you can buy your first ETF. Then afterwards, set up the automation so that it keeps happening every month. That's it. You're an investor now. Now, if you need a little bit more guidance on which ETFs to buy and why, then I have a full video about that. The link is right here and you can watch that next. And if this helped you, share it with another woman who needs to hear this, because the more of us who invest, the more financial power that we have.